dark for Newgen Software. The stock has been declining for the last 5 consecutive sessions, was down 18% yesterday, and even today it's down close to about 10-11% now, lower on Newgen Software. The company's top-line growth came in at about 18% on a year-on-year basis. EBITDA, though, was very strong, surging to 28.4%. Virender, Jeet, CEO of Newgen Software Technologies, is now joining us on the show. Thank you very much for joining in. While it is an 18% growth that you've seen on a year-on-year basis in Q3, what the street is concerned with is that this is a company which was always growing at 20-25%. Even when we spoke to you 3 months back, you told us the pipeline is strong. There is no reason why the historical growth rates of 20-25% won't continue. So then in that context, the growth appears to be disappointing and the stock has sold off consequently. So what led to the weaker than expected numbers?
Good morning, and thank you for having me on the channel. I think you're absolutely right. I think we have been growing at a steady pace of about 20-22% for last 9-10 quarters constantly. And I think, as I keep on saying, there's no reason why that should not.
Oops, I think there is a bit of a technical issue over there, but that's Newgen Software. Pull up a 5-day chart of Newgen Software and you would see the stock has fallen close to about 32% and the bulk of the selling pressure in the last 2 days. A quick recap of the numbers, because the numbers came about 2 days back. The company's top-line growth is at 5.5% quarter-on-quarter. On a year-on-year basis, revenue growth is at 17.8%. But this is a company which over the last 10 quarters has seen a more than 20% growth. In fact, in some of the stronger quarters like Q4, the growth would be in excess of close to about 30%. And yesterday we had a Jefferies downgrade on Newgen Software too, where they're saying that the numbers are not matching up with the kind of rally we've seen in the stock price. Okay, here's what we'll do. As promised, we've connected with Virender, CEO of Newgen Software, who was telling us why growth rates in Q3 have slowed compared to historical levels. Virender, all yours.
I think we got dropped, yeah. So, as I said that, one of the issues is typically we still are a smaller number. A single deal changes the numbers for a quarter. But if you look at for 9-month period, we are still maintaining a 23% growth rate and almost a 40% PAT growth rate. So which is substantially and also is in line with the kind of numbers we have been stating. What has happened, if you look at, I think the deal wins this quarter have been very significant. In fact, this is one of the largest quarters of license growth for us. We almost grew by 70%. And that also reflects in the margin growth on that. There was an element of challenge on our execution side about larger deals which have been previously, especially in the public sector and government front, which has typically taken the downstream revenues have got slightly delayed. And if you look at our annuity revenues have not really kept pace with our growth of licenses. That's where challenge. We do think that it will take a couple of quarters to streamline that, and we should be able to still compensate that by higher deal rates and higher wins. So we are on track. I don't see a lot of challenge out here.
So you're saying it was execution challenges for some of the large PSU bank deals which hurt growth this time, but for the full year, you're on track to clock a more than 20% growth. Could you inch even higher? Because Q4 is typically stronger for you.
Yeah, so Q4 is stronger and you will see the numbers are stronger. But also, when you look at the year-on-year growth rates, also the last year, the Q4 was very strong. I think, this Q3 was also based on almost a 30-40% growth over last 2 years on Q3. So these are larger quarters in the revenue, but on a year-on-year growth basis, they have the same challenge because they're sitting on a bigger quarters of last year.
So 20% plus for the full year?
We do hope to keep on continuing our growth momentum. And I think, if you look at history, we have been able to do that fairly well.
Okay, so when you're talking about implementation cycles, you've actually mentioned that implementation cycles for large-scale digital bank that you won in FY24, the execution is getting elongated. So what's actually happening over there? Q4, FY26, how do you see that particular trend panning out?
Yeah, so what we need to understand, our business typically stems from the sale of license and followed by subsequently implementation. And then what's more important for us is the downstream revenue, which is the annuity, we call the annual technical services and the support revenues. So unless the implementations are over, our downstream revenues, which are the annuity revenues, don't kick in. So some of these projects, since they get elongated, the subsequent revenue cycles don't kick in. That's the reason for the slowdown in annuity growth. So we are now, towards the later parts of these projects, and we think in this quarter and next quarter, so a lot of them should come to the end, and their annuity part of things should start, and that should, resolve the issue of annuity growth. And once the annuity growth gets resolved, I don't think our top line growth on the license win rate is significant. I think we should continue that momentum. And I think this is a midterm challenge of a couple of quarters. The deals which are winning now, at least in the current phase of last 2 quarters, are typically where their execution cycles are smaller, like 6 to 9 months to maybe 12 months. So we should be able to realize downstream revenues in these deals much quicker.
You're saying this challenge of, implementation, elongated implementation cycle, which is resulting in moderation in annuity growth, will last for a couple of quarters? Did I get that right?
Yes, we do think that the impact of the previous orders not getting into the annuity thing will last for a couple of quarters. And what we are trying to do is we are trying to compensate it by new deals and getting new deals rolled out much faster.
Okay, can you give us a sense of how the deal pipeline is looking? You said that you have a couple of new deals where the implementation timeline is in the range of 6 to 9 months. So how is that particular pipeline looking? So FY26, would you be mainly focusing on smaller scale deals?
No, we do. So basically, I think when we book deals, some of the deals are generally, most of our deals are in the span of to be executed within 1 year. But some of the government deals are always slightly longer, and they take much more than that. That's been the history of that. So what we are right now focusing on the velocity of wins. And if you look at, we have almost 15 wins this quarter. We do want to keep the wins ratios at about 10 every quarter. And once we are getting those executed, that should follow in the downstream revenue. So we do expect that our markets, both in India and EMEA, maintain the growth, while in the APAC, which is a smaller base, is already growing at almost 40% for this year. That should continue growing. But we're very hopeful that our US investments and our efforts should start showing some results. I think in this quarter, we're hoping to get some good insurance deals in US, and that should keep on adding to the momentum of the company.
So getting back to that point about, how this impact will last for a couple of quarters. So in the current quarter, your annuity revenue was just about 9% on a year-on-year basis. So are you saying that till FY26, annuity revenues could be in this high single-digit kind of range? I mean, can you give us some sense, because the street is clearly a bit concerned?
So I think what's going to happen, that generally, if you look at our annuity revenues have been around the growth rate of the company. They have not fallen back. This is the first time in last few quarters it's been seeing, but I think this quarter is more obvious. I think from here we are looking at recovering it. I think it should keep on improving few percent every quarter till it reaches for next 3-4 quarters back to that growth rate. That's how we are going about it.
Okay, and margins, 28%, is it sustainable at these levels?
See, margins are a function. See, typically we are a company which always plans for high growth. So our costs are front loaded. So our costs always are loaded at around somewhere between 17 to 20% in the beginning of the year, depending on how the planning is. Any growth rate which is above 17, 18%, keep on expanding margins for the company. And then we keep on reinvesting it for growth in newer geos and new products and new verticals. We do spend significant amount of money on our R&D, which is almost 10% of the revenue, and around 22% on sales and marketing. And that's where we keep on. So the margin expansion is a function of our business, because it's a high gross margin business. We have almost 60% of our business is typically generating high gross margins. So we are just in terms of, as soon as we grow beyond 17, 18%, we keep on investing more in growth. But the margin expansion is going to always be a function of the business. And we want to maintain a steady net margin of around 20% and roughly 23, 24% of the EBITDA margins.
Thank you so much, Virender, for joining us and explaining to us what exactly transpired in Q3. Wish you all the best for Q4 and FY20.